Everybody else? We ready, guys?
Yep.
All right. You ready, Tim?
It's going, yeah.
Okay. Good afternoon. This is Barry Wilkin with Agents Insurance, and I want to thank everybody for attending today. I think you're going to find this will be an outstanding webinar into the factor that so many of us years ago did a lot of business in the disability income market. We kind of slacked off over the years, and the disability world is good, and we're back at it again. I want to introduce you first to you, Tom Page. Tom is out of Northern California, or Northern LA, and Tom has an extensive background in sales and home office activities, and he's been tremendous in the advanced sales in the DI marketplace. So as you get going and we open up cases, you'll be spending a lot of time with Tom helping you out on how to design disability plans as well as advanced marketing programs. So at this point, I'm going to turn it over to Tom, and then when he's done in a few minutes, he's going to turn it over to Bob at Ameritas. So again, thanks for your time, everybody. Appreciate it.
Good afternoon, everyone. I hope you're doing well. A couple of things that have been overlooked lately in the disability market that you might want to think about. And one is disability buyout for your corporate clients or partnerships. It was a market that was very lucrative in the past and probably could be again for you. The chances of someone becoming disabled obviously are likely to the chance of somebody dying. But when you take a look at the disability buyout programs and set them up for your clients, you can relieve the frustration that one partner would have if all of a sudden his partner becomes unable to do the material duties and substantial duties of his occupation or the business they have. They can buy him out after 360 days. It makes a big difference to the ongoing business and also makes a big difference to the partners. One of the other things that is really good about Ameritas, and that's their specialty, occupational specialty rider. This was something that was really big back in the late 80s that got everyone into the medical market. One of the nice things about it is if a doctor is a surgeon, gets in an accident, loses 2 fingers, can still practice medicine but can't operate, he can collect full benefits under this rider and still be fully employed. So if you're looking to get into the medical market, I would use the occupational rider as your start, and then the residual, which is a partial disability, as your finish. The corporate market is wide open to DI these days, so take a look at your corporate clients, take a look at your medical clients. If you want to get into the medical business, this is probably the best way to start. So with that, I'll let Bob take it over and show the advantages of Ameritas' disability. Bob, all yours.
Thanks a lot, and again, as we go through this, what I'll try to do is to make sure that we keep it moving. There is a place for you to type in your questions. I believe that we are recording this, but I also think that most of you are muted. At the end of this, depending on time and interest, I'll stay around for once we open up the phones to answer any questions we have. So that's who I am, Bob Hiram. I've been here at Ameritas for approaching 9 years. This month celebrates 30 years in the DI business. So I started in 1986 with the Provident Life and Accident, which was one of the big 3 back then. And what's interesting, I'm now back with the big 3 because along with Guardian and MetLife, as many of you may have known, is left the IDI world, but they were obviously a major competitor. Northwestern is a major competitor. These are all really outstanding companies, and you're not taking a back seat when you work with the disability product that Ameritas has. So let me see how this, how do we move the slides? Okay. A little technical issue here. That's interesting.
You just want to have your name up there as long as possible.
Not right now. The thing's not moving. So let's see what we do on this.
You know what? I'll open it on my end, and then I'll take the screen.
Okay, next screen, please.
Well, hold on. Let me open it first.
All right, our next slide is disclosures. I'm not going to read that. If you want to read it, you can. Here are the two products we're going to really talk most about. Our DI product, and a couple carriers have done this, most still haven't. We can actually sell our individual DI product, the historical monthly indemnity product, on either a non-cancelable and guaranteed renewable basis or purely on a guaranteed renewable basis. And I'll go into that in a couple seconds, but I want to make sure you understand that. 30 years ago, every professional was sold a non-cancelable and guaranteed renewable. Standard and Northwestern were the first two carriers that disconnected those two. We have done that, and I'll talk to you in some of the marketing ideas as to why we did that as we move through this. First off, understand the foundation product is approved in all 50 states, and the foundation product is the traditional monthly benefit contract that you're most likely familiar with. We do issue it on a separate policy, Ameritas Life of New York in New York, but for all intents and purposes, it's the same company. It's all under the same mutual holding organization. I do want to note, since some of you are in California, we do have a slightly different version of the product in California than we do in the rest of the country, and that is simply because California does have some interesting peculiarities as opposed to the other state departments of insurance. So, and I'll go into that. The other product that we have across the country, with the exception, right now we're attempting to get California approved, Florida, Maryland, New Jersey, and Vermont. We also have what I call a catastrophic disability, or sometimes we call it a lump sum disability product. We'll talk about it briefly. It is primarily designed for the middle market, those people that historically have never been approached for a traditional IDI product. Again, we'll briefly hit that. That's what the product looks like. The point there is that we've been writing DI for 50 years. Tom mentioned the late 80s. In the late 80s, there were about 300 DI companies in the business. Right now, there are about 30. Ameritas, back then we were called Union Central, is one of those that decided to stay in the business where most did. So I think that's very important, so you know that we're committed to the business, and that shows, and we show that every year in what we're doing. So here are the products we actually have. We have our non-cancelable and guaranteed renewable product. You'll see we have a different number for New York and California, but the products are, for all intents and purposes, identical. We can sell that same traditional IDI product on a purely guaranteed renewable basis. You lose the non-cancelable, but you also lose between 12 and 18% of the premium cost that goes with non-cancelable. We oftentimes are seeing this in older ages, 50 plus, where there's probably very little risk of a rate increase, but the savings are significant. Tom mentioned physicians. We are selling a tremendous number of physicians at age 50 plus. They're getting their renewal notice from the American Medical Association Group Association Plan, and they're getting hit with a double-digit rate increase at 50. They're going to see another double-digit rate increase at 55, and they're going to see another rate increase at 60. Interestingly enough, they can actually write, assuming they're healthy, they can actually go buy an individual disability product with rate guarantees and contractual guarantees for less than the renewal is on a franchise association coverage with much lesser definitions. We also have overhead, and in fact, our overhead is probably the best overhead out there. I'll be talking about a rider that we added that is proving to be extremely popular in the business marketplace. And then I already mentioned the dynamic fundamental, our lump sum or catastrophic disability product. All right, on the individual product, and this is going to be fairly similar if you were used to other carriers. We have age 70, age 67, and age 65 benefits. Only one carrier out there has lifetime, and frankly, the charge that they make for lifetime makes it very, very unattractive. Then we also have a 10-year, 5-year, 2-year, and 1-year. The one that's really sort of unique is the 10-year. That's something we did with this newer product when we brought it out 7 years ago. It's got two plays. First off, in the 50-plus marketplace, that might be just as good as buying an age 65 in many cases. It also gives the underwriter another option. As you may or may not know, oftentimes when somebody has had some health history, the underwriting offer will many times come back with a 5-year offer when the person was asking for, let's say, an age 65. I wanted a 10-year option as something that the underwriter and the agent could potentially talk about as a better offer than what you would see from other carriers. And you'll see this very standard elimination periods. 90+% of our sales in the individual DI world are sold with a 90-day wait. About 75–80% of our BOEs are sold with a 30-day wait, just to give you sort of a little flavor. Okay, let's talk about the plan flexibility, and that's frankly a term that we use a lot internally at Ameritas. In the white-collar market, you actually have 3 different occupational definitions. And Tom made a great point. In the medical market, in the attorney market, some of those professionals, they're going to want the ONOC, and that is an ONOC to include specialty definition. What we actually say, and we have a marketing brochure that talks at great length about this, is that if the AMA recognizes the specialty as a specialty, and there are 188 of those that they recognize, those we will provide specialty definition. What does that mean? That means if you were a special type of cardiovascular surgeon and you can't do those duties, but you can go be the head of the medical school at University of Southern California, you actually could draw your entire monthly benefit from Ameritas. On top of that, your income from your new occupation. The second definition is one I actually like, but I use it outside of the medical and dental or whatever professionals, and that's an ONOC not working. That's a 5 to 8% discount, but I'll just use myself as an example. I was an Army officer. In 1986, I became an insurance person for Provident. I make a very good income, but the real question would be, am I really interested in protecting my occupation, or am I really interested in protecting my income? If the answer is income, then an ONOC not working works just as well in those situations, because we don't force the person to work, but if the person does go into some other type of occupation for gain, for an income, the definition changes to a residual definition. Some pretty significant savings, though. You know, if a person can save 8% of premium and what they're really interested in doing is protecting their income, it's a nice option. Most carriers don't have that option. And I've always found clients like to have pricing and contractual options. And then in the more the gray collar type of situations, this could be a business owner that owns a plumbing, electrical, something like that, where he or she is maybe out on the job sites, things like that, will use a 5-year ONOC and not working thereafter. It's a true ONOC for the first 5 years, and then the definition after 60 months changes to that of not working thereafter. Again, we're not forcing the person into that occupation, but we're just not going to pay in addition to their income. Now, in California, it's just rather interesting, California has a couple of different things that they do. First is that they require that in the more what I'd call the blue-collar kind of contracts, that there be an ONOC not working definition. So you'll see that built into the contracts if you're dealing in Florida. And in Florida, in California, and in Florida they require all DI policies have an initial 12-month ONOC. So just, again, those are state variations that you might see depending upon where you work. Okay, let's talk about the occupational categories. Several years ago, we split medical and non-medical. So anytime you see a 6A, 5A, 2A, whatever, those are non-medical occupations. All the medical have been put into the M occupation. Interestingly enough, every other carrier followed us in that. And the reason is very specific. When you start looking at loss ratios and claims ratios, medical individuals have higher loss ratios than non-medical. The non-medical were carrying some of the costs tied to the medical claims, and so we split those out. The other carriers have followed. But you can sell basically all of the, really anyone gray collar and above, whether it be medical or non-medical, you can sell them both non-cancelable and guaranteed renewable. In the guaranteed renewable version of the product, we'll actually even allow you to go down into those A and B occupations. Those are blue and very blue occupations. Most likely you don't even work in those types of situations. So again, just about any person you work with is going to be eligible for one of our contracts one way or the other. And then you'll note that all of our policies are conditional for lifetime. And in today's world, we're seeing more and more people working beyond age 65. There's nothing magical about 65 or 67 or age 70. And so, again, we're not the only carrier that's seen that. Now, a couple things built into this policy I just want to very briefly go through. On the non-cancelable version of our DI policy, we will allow accumulation of successive periods of disability for up to 365 days. So think about a person going through cancer treatments. They might have a period of treatment followed by maybe a partial return to work, now they go through another treatment. Each of those periods of disability will be counted up, whether it be total or residual. And on the guaranteed renewable version, it's 180 days instead of 365. But both of them have very, very liberal language on how you can accumulate your different periods of disability. Presumptive disability simply means that a person is presumed to be totally disabled if they have the loss of both hands, both feet, eyesight, hearing, those types of things. Probably really the only important difference between us and other carriers is other carriers require that loss be considered permanent, and we don't do that. And so there are situations that I can cite where we've had people that have had a fairly significant stroke. They were initially paralyzed, or half their body, or loss of use of their fingers and hands and arms and things like that. The doctor is not going to say that is permanent, and so we might put a person on presumptive disability where other carriers wouldn't because of that difference. What's the big difference? Well, presumptive means that we waive the elimination period. So if the norm is a 90-day wait, other carriers are going to force that person to wait 90 days before they start accumulating days towards their disability benefit. We're waiving the elimination period. Could be pretty significant. Our policy also includes language so that if a person has a surgical transplant, whether it's to them or they're giving a body part to someone else, once they've held the policy for 6 months, they're covered for that. We also do cover cosmetic, and we also have built into the contract rehabilitation benefits. We don't spell out an amount, and that's simply because in many cases I've seen situations where we have actually paid for a special desk, a stand-up desk, because the person has back problems, and so what we don't want to do is limit our options. If it helps us get the person back to work, even on a residual basis, that's our goal, obviously. Now, we have some interesting things that I want to make sure you're aware of that are industry unique. The first is called treatment of injury, non-disabling injury. I came from Provident Life and Accident, which had this feature when it still existed. It no longer exists. But in addition to the total disability or partial disability, we'll have situations where, particularly with younger people, where they will say, Bob, I really can't see myself being disabled 90 days. Interestingly enough, a lot of times these are doctors, and they're working with people that never thought they would be in a hospital. But again, the fact is that young people typically think that they're indestructible, and they'll find a cure for death before they get to old and gray. Well, what our policy will do, and it's built into the policy at no additional cost, is we will reimburse an individual for treatment of an injury, and that reimbursement can be up to 50% of the monthly benefit, not to exceed $3,000. So if you had a situation where you fell down the steps and you broke your ankle, you're going to have medical expenses. You probably have a high deductible medical plan. You probably have co-insurance and deductibles and all those types of things. What we're doing is, and again, unique in the industry, is you send in a short form claim form along with copies of your medical receipts, and we are reimbursing you from $1. We don't coordinate with the health insurance at all for that non-disabling injury. I've seen this be the difference between a sale and no sale, particularly in younger individuals. Every carrier has waiver of premium. Typically that's going to waive after the elimination period. In the case of presumptive, it waives immediately. Good health is another unique to our industry, and it's so good we oftentimes don't talk about it. Each year the person holds the policy monthly benefit free, so treatment of non-disabling injury does not count against this. So a person has held an Ameritas policy for 5 years. They then would become disabled. The elimination period they selected was 90 days, but because they went monthly benefit free for 5 years, we actually take 2 days off of their elimination period for each year they go monthly benefit free. So instead of writing the first check on the 91st day and after, we're actually taking that elimination down to 80 days. Now, we will not take it down below 30 days in total, but again, just like with the treatment of non-disabling injury, those are features. What I always try to stress with the individual is how does that benefit them? And so in a real simple example, let's just say we had a $5,000 monthly benefit was the person's policy, and we had taken 10 days off of their elimination period because they've held the policy for 5 years. The way I might explain it to them is that we're writing a check 1/3 of a month before anybody else would have. Again, just makes it real to them that this is something that is really affecting their policy. Each year they go monthly benefit free, they're having 2 days taken off of their elimination period. Survivor benefits, again, fairly standard. Most carriers have between 2 and 3. Ours is 3 times the monthly benefit payable to the surviving individual if he or she had been on disability. And then the last one on here should say unique to industry also. MetLife had one, but they charged for it. Ours is built in just like the good health and just like the non-disabling injury provision. I don't know if any of you have ever received a COBRA continuation letter. I did, not due to disability, but that letter comes in after a person has been terminated for employment. In the case of disability, they're probably having some really bad things going on in their life. They were terminated, had their employment terminated, and now they have 31 days after that termination. The health insurance carrier or the third-party administrator has to send this letter to them. And that letter tells them how they can continue their coverage and also tells them what it's going to cost. And what's going to cost is 102% of the gross monthly premium. Well, most people don't even know what their actual monthly premium is because there's probably some cost share between the employer and the employee. Well, 102% of that gross cost is going to be a big item, $1,000, $1,100, $1,200, whatever. But what choice does this person have? They were so disabled that they were let go from their employment. And so what we did when we revised the product several years ago is we added a COBRA premium benefit to the policy. Again, built in at no cost. And what it does is it links into the COBRA continuation, the federal and state laws that are out there. So if a person continues their health insurance, paying for it, we will reimburse up to $1,000 per month for up to 18 months. Again, at a time when a lot of things are going wrong in a person's life, they've been let go, and now they have this big premium. The $1,000 may not cover all the cost, but it's going to cover a significant part of that cost. And again, as I like to say, who else is writing the monthly benefit plus up to $1,000 reimbursement on top of that? And again, there's no additional premium charge for that. All right, some additional riders. We have 2 residuals, and I'm not going to go into great detail because I've got a real handy brochure that I'm going to show you later that goes into both of those. But the enhanced residual is the one that you're going to want to use in the professional marketplace and the executive marketplace. It does two things. First off, it is going to be paying a benefit based on the loss of income that that individual has. And what you'll find in most medical practices or dental practices is that the person returns to work on a part-time basis, but their income will not be identical month after month. It's going to go up and down. A lot of it's going to depend upon the medical problems they're having and what the treatments look like. The enhanced residual handles the ups and downs of that income. As long as the person has a 15% loss of income, it's going to kick in and create this benefit flow to them, and each month is going to depend on how much are they losing compared to what they were making before. The other thing that the enhanced residual does, and this is, again, pretty unique out there, is that once the person returns to work full-time, they've been released from the care of a physician. The other thing that this provision has built into it is as long as they continue to have a loss of income, they've been released from the physician, they're working full-time. But let's face it, if you were out of your job, out of your business for 6 months, you're not going to see your income come back immediately. There's going to be a lag, and maybe that lag goes on for months, maybe it even goes on for years. As long as they continue to have that 15% loss, even though they've been released from the care of a physician, we're going to continue to pay a residual benefit to age 65 or whatever the benefit duration is on that policy. So again, that's built into the policy. The basic residual is really designed for the small business market. And when you think about residual, remember one of the things is you have to show a loss of income. Well, in many cases, a small business owner may or may not actually have any kind of loss of income in the short term. Depending upon the business and how many employees he has and how good the staff is, it could be that he would have to artificially reduce his or her income in order to qualify under most residuals. So we built a basic residual is what we called it, and really what it's doing is it really parallels the old partial disabilities where if the person had a period of total disability, now they come back to work, we're just going to pay out a partial benefit and they don't even have to show a specific amount of loss of income. So it's a very simplified version of the enhanced residual, but it is designed for a fairly small market where the person has the choice of, do I want to take my entire income or do I need to artificially reduce my income in order to qualify for disability benefits? That seemed like a bad choice to me. We also have a social insurance substitute. This is usually used as a cost saver in the middle marketplace. You don't see this used much in the corporate or the medical or dental fields. It can be fairly significant savings, but the negative is that the insurance carrier, Ameritas, is going to require that the person continue to show that he or she is filing for Social Security, and that can be fairly onerous. So again, it's used as a way to save money more in the middle market. We have two cost of living adjustments. 6%, it really should say 1 to 6% compounded. I call this a Cadillac COLA, but it also costs more than a Yugo. And so when we brought out the new product, I also introduced or recommended we introduce a 3% simple. It's about 45% of the cost of the 1 to 6 compounded. But what I like about it is if you look at over the last 20 years of what the CPIU has been, it's averaged just around 2.3, 2.2% increase per year. The 1 to 6% compounded is actually going to go a minimum of 1 and a max of 6, and that's compounded, and so that's good. But the 3% simple, and in many cases, might actually be better because 3% is both a floor and a ceiling. I don't care what the cost of living increase was for the prior 12 months. If it was 1 point, you're still going to get a 3% simple adjustment. If it was 5%, you're still going to get a 3% simple. So what I like to say is, when is 3% simple better than 1 to 6 compounded? tell me what the CPI-U was for the prior year. But more importantly, when we introduced the 3% simple, we saw a very large increase in the number of policies sold with the cost of living rider. The problem with the COLAs is they tend to be expensive. A lot of agents and or clients, that might be the first thing they take off a policy. I actually called an agent one time and I said, why don't you sell COLA? And he said that the average claim was 2.2 years. I said the problem with averages is that means half the people had a claim that lasted more than 2.2 years and half were less. If that person, if all they're going to have is what you sold them for the next 20 years, they may be unhappy that you didn't at least talk about having a cost of living adjustment. The automatic increase in the non-professional marketplace, we use something called automatic increase rider, AIR. It is a 4% simple adjustment. This costs nothing to have in the policy. They only pay an additional premium if they exercise that option. So each year for the first 5 years, they have an automatic right to increase their benefit by 4%, and they're also told exactly what that new premium cost would be. At the end of those 5 years, they can apply for additional increases. I use this in the middle market where they're not seeing large increases in income. I don't use it in younger professionals where they when I'm talking to them, they say, well, in 3 years, I would expect to be making twice as much as I am now. I'm going to use a future increase option, which is the next thing shown here. An FIO is a guaranteed right to buy additional coverage and only have to show the financials to support it. There is no medical underwriting of the future increase option. And what you get with Ameritas with our FIO, and it costs 10% of the base premium to have an FIO, but we guarantee the occupational class, and anyone that survived the 80s and 90s know what I'm talking about. Doctors went from being a preferred risk to being something slightly above stevedores in the eyes of many of our underwriters. So you guarantee the class, you guarantee the occupational definition that went with that occupational class, and finally we also guarantee what will the rates be when you make that exercise 2 years, 5 years, 10 years, whatever, into the future. And our FIO, let's just say that our average young physician is 32 years old. They have a guaranteed right up through age 50 to lock in the rates, the occupational definition, and the occupational class. That's why we charge 10%. And then finally, we have the, and this was something I wish we'd had when I was out there personally selling, and that's the catastrophic disability. Think of this as a rider on the back end of the policy that pays additional benefits if the individual is unable to perform 2 of the 6 ADLs. And I don't know how many of you sold long-term care. I sold a fair amount of long-term care. I always found it to be somewhat of a difficult sale because oftentimes they were in their 70s or even lower 80s, and oftentimes I had trouble with one or the other. To me, the CAT has 2 things. First off, it's creating more dollars if that person has that catastrophic disability. There's probably going to be additional costs associated with care, whether it's home or hospice or in an institutional care. Obviously, those costs can be rather extraordinary, as most of you probably know. And the other reason I like the CAT rider is it does sort of initiate that conversation with that 30, 40-year-old that, you know, in 5 or 10 years, we may want to sit down and talk about true long-term care insurance, whether it be a living benefit, life insurance policies that I'm sure you're aware of, or a true LTC. So again, it can promote additional sales on the road. Now, the enhanced residual that I talked about is available to all the 3A and above non-medical, and also we can sell basic residual and enhanced on all medical ops. In fact, it's required. And the reason we did that is we don't want a situation where a physician finds themselves that they bought a policy without a residual rider, and we know that the vast majority of doctors are going to try to return to work, even if it's on a part-time basis, and so that's why we require it. You'll note in California, again, I know some of you are in California, California actually requires residual be built into the policies. It's not a rider in California. And the other thing that's rather interesting is that they require us to call it partial. So every 49 states out of the union, it's called residual, but in California, us and the other carriers are required to call it partial. But again, it's built into the policy. It's not a rider in California, if that's where you're writing. The basic residual is again available 2A and above, so pretty much anyone that is gray collar or even a little blue collar and above, and 3M and above in 6M medical occupations, that is nurses and lab techs and above, so pretty much wide open. And then again in California, again because they require it to be called partial and because it's got to be built in, when you quote it, you won't have an option. They'll show the other residual as required. I already mentioned some of this. I'm going to go through it fairly quickly. The enhanced residual and the basic residual only require that 15% loss. And then you'll note we have an or here, the inability to perform one or more of the material and substantial duties, or the inability to engage in your occupation for 80% of the time. So again, some carriers have an and in there. Ours is one of the more flexible and has the or in there. So again, 15%. Industry norm is still 20. There are still some carriers out there with a 25%. I want you to note that there are never any days of total disability required. It can be satisfied with either total or partial disability. And again, anything more than a 75% loss on the enhanced is going to be considered total. So again, they'd get the full monthly benefit. Again, pretty important to note here, we will allow either cash or accrual. And that's important because what you'll find is that most, especially physicians, most of them are probably working on an accrual basis, but what we usually suggest to the accountants that are working with that physician is do the mathematics on either a cash or accrual, determine which is most beneficial to them, they get to choose that. And then you'll note that whether it's the enhanced or the partial, enhanced, we're going to pay out a minimum benefit for the first 6 months of 50%, and then on the basic residual, it's just a flat 50%. Again, that's why I say they don't have to continue to show the loss once they've initiated that claim. Not really going to go into this. Again, they get to choose the last 12 or 24 months. Again, typically this is something that's done at claim time to get the most advantage, to show the greatest loss to the insurance company. I mentioned earlier that both have the recovery benefit. Again, it's built into the policy. And what's really nice about that, as long as they maintain that loss of 15% and there's a demonstrable relationship between the loss and their prior period of disability, we're going to continue to pay those benefits up to the full benefit period. So again, very, very strong residual. Partial disability is actually built into the guaranteed renewable version of our policy. Again, it's a dialed down residual. That's why it's called partial. And you know, again, what it's really doing is it's got to boil it down, it's going to have a 50% maximum monthly benefit, and that's payable for up to 12 months. Again, that's the built-in. If they want the basic or they want the enhanced residual, those are riders. This is actually built right into the policy. All right, in California, hit most of this, but in partial or enhanced residual, or partial is required in all of our policies. You're going to see it listed in the base premiums. So if you run a quote in Montana and then you run a quote in California, they will look slightly differently because the partial premium is actually built into the California version. And again, I think the rest of it we've hit. All right, we talked a little bit about the 1 to 6 compounded COLA. Again, I call this a Cadillac. This is one of the strongest COLAs out there. You can see it's eligible for just about all of our occupational classes. It is tied to the CPIU, minimum of 1 up to 6%. Then one of probably the two nicest things about this rider are, number one, when a person returns to work, they can actually buy those increases, and so that is an option that is not available on the 3% simple. The other thing is that, let's say that we have a period of 2, 3, 4%, and then we suddenly have a spike, and most of you probably don't remember the late 70s, but suddenly, it goes up to 7, 8%. We actually have the ability to use some of that unused cost of living increase in that year where it spikes. So again, that's why it costs considerably more than the 3% simple. Again, the 3% simple was a price play because a lot of agents and clients were not buying COLA, and I thought it was important that they at least have that discussion. So it's available just about to every OC class out there. Very simple, 3% simple. It's a flat, so as I said before, it's either a floor or a ceiling, whichever way you want to express it. But again, there is no catch-up feature. But again, the idea here was the person's better off owning a 3% simple COLA than no COLA. Social insurance, again, available basically to all occupational classes out there. You don't see it used in the professional or the ranks, the medical market, the dental market, some of the other professionals. However, we do have a very good social insurance substitute. And what this is going to do is it's going to pay additional benefits if the person is disabled and not receiving either, in California, it's a cash sickness state, but in other states you could have workers' compensation and Social Security, and those are considered social insurance benefits. The definition of the rider follows the base policy. So if they bought an ONOC, they're going to have the same definition there. But the bottom line is this is typically used to help reduce the cost to the insured because these dollars cost less per 100 than base benefit guaranteed dollars. And that's because we know that in about 1/3 of the cases, people are eventually going to be approved for Social Security, and so our benefits will reduce when those Social Security or other social benefits are payable. Just a brief illustration of how it works. Let's say that the individual bought a $3,000 base and $2,000 of the SIS rider. So the gross benefit would be $5,000. If the individual, make sure I can read this correctly, if the individual received $1,250 of social insurance substitute, we would be responsible for the difference, which is that $750. So we would be paying the $3,000 plus the $750. Now the person still has $5,000 coming in because $1,250 plus $750 plus $3,000 is $5,000. But again, part of it is contingent upon Social Security. If Social Security paid the full $2,000, we would not have to pay anything on this rider. Again, that's why it costs less than base benefit dollars. So again, there's nothing wrong with it, but again, in most cases, there's no question that individuals at the lower end of the spectrum are more likely to be approved for Social Security than those at the higher levels of income. Mentioned the automatic increase rider called AIR, again available up and down pretty much all of our gray collar and above. Again, this is the way that benefit I would use in the non-professional marketplace where the incomes are going to go up, but they're going to go up because of cost of living increases, promotions and things like that, but there's not a huge increase in the offing. Again, this is 4% simple, so it will help maintain the policy, the buying power of the policy. It's not a way to make up substantial increases in income. Wide availability, 18 to 55. There's no cost to have it at the policy on issue. 4% simple, as I noted before. No financial or medical evidence required. So again, they get a letter each year for the first 5 years. Additional option 5-year benefits are available with only financial underwriting. minimum size policy $1,000. The thing to note is probably the last bullet. If they forfeit one of those options, they lose future options. And so just need to understand the good news is, as an agent, you get paid first-year compensation on each of these increases. You get a copy of the letter. Your insured gets a copy of the letter. Just encourage them to exercise those. Future increase option. This is the rider that is used in that marketplace where the individual tells you I'm making $160,000, but I expect that to double in the next 3 to 5 years. I'm going to put a future increase option rider on there to guarantee them the ability to buy that no matter what might happen to them medically over the next few years. Available to be issued up through age 50. Again, no medical evidence when they're exercising, only have to show that they can justify it financially. Through age 40, after the policy issue, the person can exercise up to the full amount. After age 40, I'm not sure what that is. Are you guys still there, Tom?
Yeah.
I'm here.
Okay. I love those little sides there. Don't know where that was. So after age 40, you'll note that they can exercise up to 50% of the base benefit on each anniversary, but they can do that up through age 55. So a couple of carriers match us at age 55. Quite a few carriers still limit it to age 50. At time of issue, we will allow the person to buy 3 times the base benefit. So let's say the person bought, not to exceed our max IMP, so if they bought a $3,000 policy, they're coming out of medical school or a residency, whatever, they could buy an additional $9,000 of FIO, and that's not going to exceed the max issue and participation limits. So again, as I noted, it guarantees rates, which is important, guarantees the occupational class, which is very important. A lot of carriers do not do that, and most carriers do not also guarantee the language of the original policy. So if they bought an ONOC to include specialty, 5 years later, even if we suddenly are having really bad loss ratios on ER docs, for example, they're going to have the ability to exercise that with a true ONOC to include specialty. CAT rider, about 25% of our policies are sold with CAT. It's become very, very popular. Again, very wide applicability. I will note it's not available in California and Connecticut. Those are probably 2 of the more difficult states to work with for whatever reason. And in Texas, they would not allow CAT. So what we did was we actually, the CAT definition in Texas actually uses the presumptive language and severe cognitive impairment instead of the 6 normal activities of daily living. But we are actually in the midst of talking to California about doing something similar to that, but I want you to note that right now we don't have CAT in California. Here are the 6 ADLs, and again, those are standard in the industry, so I'm not going to spend much time. Probably the nicest thing about CAT is it's a very flexible benefit. First off is we will allow between the benefits that they're purchasing you to take their benefit up to 100% of their current insured gross income. So I'm just going to use simple math. Let's say the person was making $100,000 a year. Make it easier, $96,000 a year, so it's easier math. And so let's just say that the monthly benefit we would insure them on a basic policy was $6,000 a month. Well, $96,000 is actually $8,000 a month. So we would actually allow you to sell a CAT benefit on my example of $2,000 a month. So they would have the $6,000 of base benefits with the ONOC definition, and then they would have an additional $2,000 being payable if they met the definition of unable to engage in 2 of the 6 ADLs or severe cognitive impairment. And so very, very nice benefit. Again, I like it because it really creates a discussion of maybe some future sales at some future time. So again, the other thing that is very unique is, let's say that you put a 90-day wait on your base benefit. We actually allow you to slide the elimination period for CAT. It could be a 180, it could be 365, 730. So you can actually design it truly to meet the catastrophic needs of that individual, so you don't necessarily have to have it match up with the base benefits. The other carriers out there, for the most part, require it to match the base benefits. So we're a lot more flexible in that regard. And again, just a real simple graphical portrayal. Got a $280,000 income, and so $12,400 if you went to our issue and participation, that's the max we would issue. But we would allow a 10,000 CAT because the combination of those two equals 100% of that 280. And again, it works the same way at the $120,000 of income. They've done a $6,000 of benefit. 120 is 10,000 a month, so they could sell the difference, 4,000. So they're protecting 100% of their income. And then at the lower end, if you were just selling basically what I would call a starter policy, you got that $1,000 of base benefit. You can sell $3 of CAT for every dollar of base benefit, so that's where you come up with the 3,000 CAT max. Sort of seeing how I'm doing on time. Let's see, I'm going to skip that. All right, we've got here the normal exclusions, limitations. You will find slight differences in language depending upon the states. Some don't allow the term incarceration. Some don't allow the words war or active war. They've added language about terrorist acts. But for the most part, these are probably true in 45 of the 50 states, and the others have slight differentials. I do want to note that we do have mental, nervous, and substance abuse limitations on our policies. I'm going to make it real simple. If you're selling in the medical occupations, you're going to find that that's a 2-year mental nervous limitation for the life of the policy. If you're selling in the top occupational, non-medical occupations, it's a 5-year. If you've sold any group LTD, you know that all of those policies have 2-year limitations. So frankly, we're no worse off than any of the group carriers out there. The other interesting thing is there is at least one carrier out there that does not have mental nervous limitations. However, it's interesting, a lot of times they will not issue policies because they don't have that language in it, where we can issue a policy because we know we either have a 5-year or a 2-year limitation. So it seldom comes up, and I want to make sure we talk about it. All right, real quickly on some of the discounts, and again, you're not going to be able to remember everything. I assume you'll get a copy of the presentation. We do have a 25% load for tobacco. We have really a multitude of ways to get to discounts. The simplest way is we have a 15% sex distinct with any situation where you have an employer sponsorship and we have 3 or more lives. And once the discount is established, it doesn't matter if that group falls below 3 lives. We sell those all day long. If you have that same kind of group and you can get 100% participation or employer paying the entire premium, instead of 15, it goes to 20%. We also have, and it's probably it needs to be another discussion, we do have guaranteed standard issue programs. This is sort of a newer way that many of the carriers, to include us, are marketing in the multi-life platform, and those discounts range from a low of 15. In most cases, you're talking 20, 25, or 30% off of the unisex rates. The other thing you get with GSI is you get out of the underwriting. On our application for foundation, you have 4 gatekeeper questions, and if they can answer those questions appropriately, there's no additional underwriting, so it just makes it a lot simpler. We also do have a 15% association discount. Those are sex distinct, and in fact, we have about 150 associations across the country that we market to. I know many of you are actually have a working relationship with the one we have there in Phoenix for the medical association. But again, we have the American Bar Association, for instance. So if you have either an opportunity to talk to us about an association, or if you want to know if we already have an association discount set up, I'm your point of contact. We also have an initial premium that is available and it's used actually a lot of times at the end of the year. It's called the 5% double annual. So if a business owner is looking for some ways to maybe maximize some discounts and take the write-off at the end of the year, pay 2 annual premiums, and he can take 5% off of each year's premium. And so again, we see this being used in the last quarter quite a bit. And then the last one is one I manage for Ameritas. If we get into a large case, and I'll give you an example. Just recently, we've gotten engaged with Haier, which is a Chinese company, bought out a large portion of the GE electronics company out of Louisville. We established a big case discount because we know we're going to get at least $100,000 in premium, and so our agent in Louisville is able to go out and work with the executives of Haier, which that came with the acquisition, and offer them a 30% discount off of street rates. Not a bad opening gambit to a discussion. I'm going to very briefly hit Fundamental. Fundamental is a new product introduced in October of 12. It is a industry unique product in the United States. It's not new to Europe or New Zealand or Australia, and you can see the approved states were in all except those 5. So 45 states plus District of Columbia. The tagline here was simple, affordable, attainable. One of the things that agents and clients told us is that traditional DI policies are too difficult to get underwritten, too difficult to explain, and too expensive, particularly in the middle market. So we focused on a middle market that we defined as those making between $40,000 and $100,000 that have little or no DI coverage. We also made this available to homemakers, literally people that have no income. So a couple of unique markets there that you might be interested in. It pays a lump sum benefit if the person is unable to engage in any occupation that's reasonable based on their education, training, experience, that the disability is expected to last at least 365 days, and they have to survive the disability 30 days. Just pays a lump sum. So if you have an individual that makes $80,000, they could actually buy a lump sum disability policy that pays them, if they meet the 3 criteria I just listed, it's going to write a check for $80,000. We've had actually a fair amount of success with the policy, but we did have some pushback on the fact that disability has to last at least 365 days. So I'm going to tell you something I have told no other group. As of the end of the first quarter, early in the second quarter, we will be adding at least 3, probably 4 riders to this product. We are going to add a critical illness rider, an accident-only rider, a CAT rider, and most likely going to be adding a very simplified student loan rider to this product. So we're going to take it from being not only unique in the American disability marketplace, but also being one that is one of the most flexible and malleable out there. Each of those riders stands on their own, and if a person bought none of them, the average pricing right now, and I do this every quarter, is $46 a month. Even with the riders, we're thinking it would take it up to a max cost of around $65 if they purchased all the riders. But of course, they don't have to buy all the riders. So again, very interesting product. It's got a 6-page app versus our normal 20. There's literally no underwriting other than MIB and a script checks. Issue ages 18 to 60. It uses the guaranteed renewable chassis. You only have 2 occupational classes, 50% or fewer manual duties or more than 50% manual duties. One of the things agents said was it's too difficult to oct some of these blue and gray collar occupations. This product is not available for medical. It's also not available in certain high-risk occupations. However, that high-risk group are those people that work with explosives, firemen, police, very few ineligible industries. And it only has 2 payment options, monthly or annual, and that's because monthly has the best persistency. The second highest persistency is annual. Real short and sweet. Minimum policy size 25. In $5,000 increments, you can buy up to 100. If they make more than 100, they can buy up to the 100. You either have a choice of a single lump sum or a 6-month payout. half a dozen states required the option of monthly benefit payable versus the lump sum. There are no riders. It's sex distinct, and instead of a 25% load, it's a 20% tobacco load because that's easier math. With this product, you don't even have to send in a copy of the proposal. In fact, it can be quoted on your smartphone, your smart device. Really a neat little product, and again, when we add these riders, I think you're going to be impressed. I want to run very quickly, show you a couple of the tools that are available. I'm not going to run through each of these, but we've actually developed earlier this year a character called Parker. In fact, I now have a t-shirt sitting on my desk saying, "Be like Parker." These are videos that are designed for the consumer. The way we hope that you'll use this is you have a meeting coming up next Tuesday at 8 o'clock at Starbucks for coffee, and prior to that meeting you send out a reminder, maybe here's what to bring to the meeting, but you could attach this video. Oh gosh, make sure this works.
Meet Parker, like all of world, building his life, paying for things like his sporty car, utilities, and his home. He is working hard and putting in long hours at work to pay for his new lifestyle. New expenses keep being added, but Parker's income.
All right, I'm not going to run through the entire thing, but this is a 1 and 40-second video. There's now a second video that has been developed. And again, these are things that you can send out to your clients, and more of the materials that we have developed are frankly designed for the consumer. Most carriers tend to focus most of their marketing material for the agent and broker, and we have all that stuff. We have just short of 200 marketing pieces of one stripe or another. But more and more of our stuff has been designed for you to use with that client, a face-to-face or a telephonic or whatever conversation. And what I'm showing you here is the first of 9 pieces that have actually been developed in 8 pieces, and a 9th is going to come out next week, where what we've done is we've broken down the DI policy, very similar to what I just went through with you. I talked about non-cancelable and guaranteed renewable versus guaranteed renewable. Well, this brochure talks either the agent or the agent and the consumer. What is the difference? What are the advantages and disadvantages of both? And again, to the medical market, I would probably never have this discussion unless they were, as I talked earlier, an age 50 plus. But if I'm talking to a business owner that has nothing else in his business guaranteed from a premium cost standpoint, it is sort of interesting sometimes that we think we have to sell a non-cancelable and guaranteed renewable policy with level premium stage 65 when nothing else in his practice is going to have the same cost or premiums associated with it in the next 5, 10, 20 years. And particularly, we have a brochure, it's one of my favorites, I helped develop it, it's called DI for the Cost-Conscious Buyer. Well, almost every buyer is cost-conscious, really, when you get down to it. And what I show, and I'll send this to Tom and Barry after this call, what we show is how you can take a very traditional-looking proposal, the way that most of us would typically have sold this, and using some of the things that I've talked about, take that premium and reduce it by about 40%. Now, some of them I would do, some of them I might not do, but the bottom line that I was trying to get as we developed the brochure is I want to take a no sale or call me in 3 or 6 months. I want to make it a sale today, and that's what our product allows you to do because of the flexibility. So the first one was on guaranteed renewable versus non-cancelable. Somebody's phone's going off. I'm competing with that. The next one talks about the 3 definitions of ONOC that I hit. And then we go into the riders that are available, and so you've got one for the Social Security. Again, I describe this as a cost-saving option. Built-in features, this is talking about the non-disabling injury, the good health benefit, and the COBRA premium benefit. Got building a stronger policy, that walks them through both the enhanced and basic residual. And then finally you get into the FIO. again, for the younger professionals, particularly very important. And then the protection when you need it, that's talking about the cat rider. And again, hitting all the points I just made, but in a much more photographic and graphical portray, which is a lot friendlier. Keeping pace with inflation is obviously talking about the COLAs that are available. And so again, the one that's coming out next week is on the automatic increase rider, the 4% simple that's guaranteed for the first 5 years with future options available. Again, what we're trying to do is to create things that you can use to help you explain the policy, but more importantly to that neophyte insurance poor person that has never had a discussion about disability. We tend to be a part of the industry that has lots of acronyms and lots of riders, much more difficult maybe to explain than most of the life policies out there. And yet what we're trying to do is to drill it down to the basic components and put it in a manner that people, whether they're new or not so new to DI, can explain it in a face-to-face setting. I'm going to skip the question only because this was designed, bottom line, I answered this before. We've been writing DI since 1966. I'm not real smart, but I think that means we've been doing this for 50 years, and so we know what we're doing. I'm going to give it back to Tom now, and I'm available. I know I've gone over our time, but hopefully there are some things that you were interested in hearing, and I'm available to answer any questions if we want to have that option.
Hey, this is Barry. We've got about 6 or 7 questions. I think what I'm going to do, Bob, is I think I'm going to send those questions, most of these questions to you, and then I can get it out to everybody. But a couple of them that I thought might be really getting right now is, one of the questions is there any break in underwriting for multiple lives? You know, you've got the discounts on the program, and one of them is asking if there's any break in underwriting if they do like 3 or 4 business owners.
I missed the first part. Did you ask if there was any break on underwriting? Is that
underwriting break in case there's one guy that's got a little bit more underwriting problems than the next?
Yeah. Well, I wanted to make sure I understood. First off, I'm going to put my underwriter hat on. I've never been an underwriter, but I work with underwriters every day, and Paul Zimmerman, our head of underwriting, and I do a lot of our training sessions together. If you know you have a known situation, I'm going to tell you surround the bad risk with good risk, okay? So will it be taken into account? Yes. Now, if the guy or gal is just uninsurable, it's a train wreck waiting to happen, it probably won't suffice. But I did have a situation earlier this year. One of our GAs that I'm a friend with called and he said, Bob, I've got an 8-person physician group. One of the guys, and it was actually his client, an existing client, had some significant sleep apnea problems and frankly had some weight issues too. And what I said to him was the same thing I'm going to say now. Surround that app with 7 good apps. And that's what he did. So his presentation to that practice was, I need to do this coordinated. I need to send in Phil's app with other healthy apps. And so he was actually able to turn it into a positive. But let's just say it's just a height, weight, or some other more middling things. Definitely, you will see a little better underwriting, but send it in at once. Don't send in the worst case first and then say more good apps are going to follow, because underwriters might look under the pillow on that one a little bit, okay, or under the mattress. And also, the other thing I'm going to tell you is explain what you've got. We're a little old-fashioned. We're a mutual company out of Cincinnati. That's good and bad. But one of the really good things is you will have a recurrent relationship with an underwriter, number one. If we don't swap them out, very seldom does that happen, number one. Number two, you have a chance, and we want you to explain the situation. I've known the business owner. He went through divorce. He went through, lost his mom and dad in an accident. Explain negatives that are out there. If it's financial, went through a problem, a period of time, found some good replacements, and so that blip in financial last year was an aberration. Sell the underwriter Make sure that they know what you know, because again, all they get to look at is sort of facts and figures on an APS or on an app. So use a cover memo, a cover email, whatever you want to do, but explain what you have. And if you know that there's some known health history, what I used to do is, if they said they were taking particular drugs for mental nervous, I'd say, did something happen that precipitated that? Well, yeah, I had one of my sons was having some real problems, or I went through a messy divorce. Those are things that they can put into the underwriting fulcrum, and it will help you just with that other individual, but then as you surround it with other premium. Long answer to a short question, but yes, and frankly, don't be afraid to pick up the phone and call me with those situations. I'll walk you through how I might approach it with an underwriter, okay?
Last thing, and then we'll close this out. This will be right quick. Is there a help desk phone number for Ameritas that agents can call to talk about DI, get DI illustrations? Since some have not been busy writing DI in the last number of years.
I'm going to give you a 1-800 number. It's 1-800, and I'll send this to you also after this meeting. 1-800-319-6903, and hit option 1. Okay. There is a team of approximately 11, 12 people that sit in Lincoln, Nebraska, that are the sales support team. All they do 8 hours a day is respond to emails and or phone calls. They run quotes. They will run multiple quotes. They will answer your questions. When they get outside of their comfort zone on DI, they reach out to me or one of my people. So if they don't know, they'll say don't know, and they come to us. But they're available, and I think their hours are from 7 till 6 Central Time, so that would be 4 o'clock California time. Okay?
All right. Well, listen, Bob, thank you so much. A lot of information, a lot of other things for us all to absorb, and we'll start working on some of these items and get moving forward. But I do appreciate your time.
No, I appreciate it. Sorry I went a little long, but 56 slides in that damn thing, and I didn't feel like it.
I did some today that were 70, so I know what you're saying. Thanks.
All right. Hey, thanks for the time, guys.
Bye.
All right. Bye-bye.